Welcome, everyone. I'm David Sung, President of Nicola Wealth. As many of you know, our Strategic Outlook is one of our signature client events on our Nicola Wealth calendar, where we get the opportunity to get together with all of you in person and to connect socially outside of our offices. However, as you also know, these are not typical times, and we hope your families, your colleagues, and of course yourselves are safe and well as we continue to navigate this unprecedented global pandemic. You know, in spite of these challenges, it is so amazing to see such a great turnout for today's discussion. And on behalf of John and Rob, myself, and the entire Nicola Wealth team, I want to welcome you and thank you for attending this event and for engaging with us in this virtual fashion. Our goal today is to give you an update on our thinking as we begin to emerge from the pandemic. After a year of lockdowns, civil unrest, and political upheaval, and as vaccines roll out around the world, today we'll take a look at the post-pandemic future. What are the current developments shaping the economy, our industries, and the markets? Additionally, what lessons can we distill as we move into a post-COVID world? Is this the latest great inflection point for the global economy? Today, we want to give you a sense of how we consider the different components of the financial markets, how they are operating right now, and some scenarios for you to consider with your financial plans as we all look for a fresh start in 2021. With hindsight, we know investment markets did exceptionally well this past year. However, it would have seemed incredible to think that during the depths of the market drop last March, when indexes dropped 33% in 4 weeks, that we could be sitting here today looking back at a net gain over the past year. For many people, at the depths of the market drop last March, there was fear and panic and a rush to sell to cash. Our investment framework and planning philosophy did what they were designed to do: protect our clients against the worst of market losses while investing in areas that have benefited as economies and markets have recovered. Now, looking back at the first quarter of last year, on a year-to-date basis to March 31st, 2020, the wider stock market benchmark indexes had fallen over 20%, while our Nicola core portfolio was down just over 5%. At Nicola Wealth, we've honed a philosophy that essentially takes the market chasing and the market timing aspect out of investing and allows us to make better decisions based on a more consistent and stable approach. We adhere to an investment strategy that is designed to mitigate investor emotion and ensure that our client portfolios are truly diversified. Why? Because generally we find most investors tend to overreact and they make poor behavioral finance decisions. When markets are doing well, investors become greedy and tend to buy at all-time highs to make more money. And when markets are going down, they become fearful and sell at all-time lows to avoid further losses. Overreaction can cause people to fall into that most substandard of strategies: buying high and selling low. Now, there are a number of fear and greed indexes out there. Just Google the term and you'll come up with dozens of them. Now, I came across this one, which I thought captures the picture well. Now, starting with the blue line on this chart on the left-hand side, in 2007, when the stock market, as represented by the S&P 500 here, was at its highest peak since the tech crash, which I have now just circled in green, if you look above that to the top of the page at the jagged red line, the red line shows how much investors had invested in equities at any given time as a percentage of their portfolios. And at the peak of the market in 2007, it was close to 90%, as I've just highlighted with the red circles. In other words, investors were close to fully invested in equities, not holding much in the way of cash or bonds, when the stock market crashed going into the great financial crisis of '08. Now, after the market declined over 30% in 2008, investors, out of fear, they panicked and sold their equities at the bottom. And you can see the red line shows us that they held about 20% of their portfolios in equities at the bottom. Investors sold low. Now, after a 12-year bull market run, looking at the far right of the graph, you can see right before the March 2020 COVID crash, investors had close to 90% invested in equities. Then the March COVID crash hits, and only after the crash, investors hit the panic button and they sell off their equities after they had suffered losses. Now, equity markets have bounced back at a staggering pace, as we all know, and this greed and fear index shows investors now with close to 100% fully invested in equities, with the market, as of this morning, hitting all-time highs. The greed and fear index is off the meter on the greed side. Now, statistically, 90% of investors do not even earn the benchmarks. Research from financial services market research firm Dalbar has found that over the past 20 years, the investors in their study earned a net return that was only 0.4% greater than inflation. Now, as you know, most investors need a rate of return that's significantly greater than that to meet their long-term goals. Put simply, volatility brings bad investor behavior. Picking quality assets takes time and patience. We believe in an approach that substantially reduces exposure to volatile public markets and is diversified into the ownership of hard asset commercial real estate, the ownership of profitable private businesses, private debt, as well as allocations to commercial mortgages, infrastructure, and other private assets. Now, over the past 20 years, taking into account the dot-com bubble, the 2008 global financial crisis, the European debt crisis, and the COVID pandemic, our clients have experienced an annualized compounded return in excess of all North American and world stock market indexes, and well above, in fact, almost 3% per year above, a traditional 60-40 balanced stock and bond portfolio, which is how most investors have their capital invested. But wealth management is more than investment returns. And while our appetite for innovation, one of our core values, remains constant, we also remain focused on our core mission: to work closely with our clients to understand your aspirations, to build, grow, and protect your wealth, to leave a lasting legacy for your families, your community, and the philanthropic causes you care about. Now, each of you is unique, and that is why, from our perspective, everything starts with planning. Our goal is to understand where you are in the financial life cycle and what you need to plan for. We begin with the end in mind. We don't believe in having a single conversation. Planning is an ongoing process, a series of conversations that address the shifting nature and issues that our clients are going to be facing, and you do face, at every stage of life. Now, we understand that wealth is much more than just money, and we will continue to seek to guide conversations with our clients, sometimes down a difficult path, to uncover the things that matter most to you. Consider these financial planning questions. Is your investment portfolio protected from volatility? Do you know how much capital you will require to meet your financial goals? Have you considered how you will create your legacy? Is your insurance positioned as an asset class and integrated with your investment strategy? Have you prepared your family to manage this wealth? Have you reviewed loans and mortgages to reduce interest costs and to determine whether, in fact, any of that may be tax deductible? Do you have a succession plan in place? Is your plan being regularly reviewed and adjusted to ensure you're on track? Now, boiling it all down to one sentence, at Nicola Wealth, our purpose is to share our expertise and best skills to help you achieve the goals and the legacies that matter. I'd like to invite our Chief Investment Officer now, Rob Edel, to the stage to share his insights on where we are a year on from when lockdown began. Now, Rob, with the vaccine rollout, we can definitely see a light at the end of the tunnel. The question many people listening today may have is, exactly how bright will that be? Over to you, Rob.
Thanks, David. Tonight, we're going to talk a bit about the shape of the recovery. And in the past, we've talked about the shape in terms of letters, V, L, W. Tonight, we're going to use a normal distribution or a bell curve. We're going to look at 3 different scenarios, and then we're going to follow up with some investment strategies. So now, I got this idea from I borrowed it from bank credit analysts. They call this Goldilocks and the two tails, and this is how it works. On the left part of the tail, you have an economy that is too cold, mainly maybe because of a 3rd or 4th wave from COVID, a risk of deflation. In the Goldilocks in the middle, you have strong growth, low interest rates, and fiscal stimulus. This is a very good environment for risk assets in the market. And then as you move over to the right, economy becomes too hot. You have the right tail, risk of inflation, and higher interest rates. Back last year in March, we're pretty sure we were over in the left tail. But we think we've moved well into this Goldilocks environment. That's why markets have been so good. The question we have is, how far have we moved to the right? How close are we to that right tail? So now let's first look at the left tail. And really, it's been a story of the vaccine rollout in the US. And this is a chart from New York Times showing that line of daily vaccinations you've seen in the US. So it's a very good news story. You've seen that line go up. It's dipped a little bit lately, but we think that's mainly because of lack of demand. The US has done a very good job at vaccinating. Joe Biden promised 100 million doses in his first 100 days. His 100-day anniversary is coming up, I believe, on Friday. They've done over 230 million. So a very good news story. According to New York Times, this is as of last week, 25% of the US population has been fully vaccinated, 65% of seniors, 40% of the population has at least one dose. They expect to have 70% by June 8th. Now, today you could probably add a couple percent to all of those totals for where we are right now. Again, very good news story. However, that doesn't mean we're done with COVID. Because you can see in this from the Financial Times, the US still has cases, about 60,000 a day. And in some regions like Michigan, you've seen a real spike in outbreak. But the real concern is globally. And this is from a chart from Bloomberg making the case they expect more deaths from COVID this year than we saw all of last year. And of particular concern right now, of course, is what we're seeing in India. But to prevent us, because we think we've moved away from that left tail, to prevent us from going back to the left tail, it's really going to be about the vaccines. And we have three questions in regards to the vaccines. The first one is, how well do they work? Do they work? And we're pretty confident they do against the normal COVID case. The question is, how are they going to do against the variants? And I list off all the variants. The concern we have would be the South African and the mutation, the double mutation we're seeing in India. And quite frankly, we don't have the data yet to tell. We think they're going to work. We think they're still going to work, but there is some uncertainty with that. The next question will be, will we take it? And this is a concern, people's attitudes towards vaccines, that people might be scared to take it. They're anti-vaccine advocates anyways. And the good news is that more and more we're seeing the acceptance rates and attitudes shift upwards. And so the dark blue is the change you've seen in various countries between just December and January. So good news story, more and more people are willing to take the vaccine. Last question, when will we all get it? And I highlight the all because I'm not worried about what I consider the leaders, the UK, the US, Israel, or even the next group where I put Canada in with a lot of European countries. We're going to get the vaccine. We're going to get the vaccine probably by this summer and reach herd immunity. It's the developing world that is the concern. How many years will it take to get the world vaccinated? And can the global economy get back to normal if that doesn't happen? And more importantly, perhaps, will new mutations come about in these countries that maybe the vaccines can't deal with? So can we fully put COVID behind us, or have we? And that is the concern. We think we have. We think we've moved away from that left tail, but there are still some risks. The market, however, has moved on. So you see, this is from Bank of America. They've polled their big institutional clients, money managers, and asked them, what do you consider to be the biggest tail risk in the market? The first one is bond market tantrum. Second is inflation. Now, we consider those right tail risks, and we're going to talk about them in a minute, but you have to go all the way down to number 4 before you get COVID. You see anything about COVID. Market and investors have moved on. And we see that, and we see why as far as the economy. We're seeing now, because of the vaccines, we're seeing the US economy opening up. So this is showing restaurant seatings. You can see how they've almost got back to pre-pandemic levels. and also travel, air travel, improving, not quite back to where it was, but moving up higher. But not all the economy has opened up. And I should also say that retail spending in March was very, very strong. But movie theaters, you haven't seen a recovery. And mass transit or in New York, you have not seen a recovery. A lot of people still working from home. So the economy is improving, but it's not back to where it was pre-pandemic. What's interesting, however, as David alluded to, the markets are. In fact, they've continued to go up a lot more. You can see in the white here is the S&P 500. It dropped 34% at the March low. It's gone on to add 91%. So it's made up everything it lost through the pandemic and added on another 25% or so. Same story with the TSX, lost about 37%. It's made back almost 80%. Markets are factoring more than a full recovery. They're not looking at the economy because that hasn't fully recovered. What is driving the markets? And we think it's two things. Very stimulative, dovish monetary policy and record fiscal policy. We're going to look quickly at both. Looking at monetary policy, you can see the Federal Reserve cut interest rates very quickly to zero. But more importantly, they're telling you they're not raising rates until through 2023, not till 2024. At this time, are they saying they're actually going to move off of 0%. And they're also continuing to use their quantitative easing program. The white line is the Federal Reserve's balance sheet. The blue line is the S&P 500. Look at that inflection point. When the Federal Reserve on March 23rd, which was the market bottom, announced unlimited quantitative easing, that was the signal for the markets to turn around. That's how important that is in the markets. It adds a lot of liquidity to the markets. Let's look at quickly fiscal policy. And this is a cartoon from the Financial Times. Martin Wolf calls Biden's last stimulus program, the American Rescue Plan, a risky experiment. And what is he talking about? Well, look at the bar charts. Look how much more the U.S. has spent, not only versus other countries, but in the green bar, how much more they spent in the great financial crisis. Let's break it out a bit, and you can see all the different programs, including the last one in March, the American Rescue Plan. Add them all up, $3.3 trillion. It's almost a quarter of GDP, a phenomenal amount of money. But they're not done, because they proposed the American Jobs Plan, that's the infrastructure plan, over $2 trillion, or 10% of GDP. And just this morning, they're laying out the American Families Plan. The price tag on that is about $1.8 trillion. So a phenomenal amount of money that you're seeing through this. And so you see all of this monetary and fiscal stimulus. It's really hard to see how the market cannot keep going up. And how could it go down with all this stimulus? The problem is the market's also gotten very expensive, and it's a question how much of this is already discounted in the market. So this is showing the Cape-Shiller PE multiple, the cyclically adjusted PE multiple, and versus its history, you can see that the Cape-Shiller is 88% above its historical average. The only time it's been at these levels was before the dot-com bubble burst. So valuation's very high. The issue with valuations is that high valuations today inevitably mean lower returns tomorrow. And you can see this from this scatter plot from the Wall Street Journal, where you take valuations and then you plot it against the subsequent cumulative 10-year return. What we've tried to do is draw in what we think is a best fit line, regression analysis, put in the current 35 times multiple on the Cape-Shiller PE, you're getting a very low return. In fact, if you go to Robert Shiller's website, he's estimating that's about 2.6% a year. Now, in fairness, on the weekend, last weekend, in Barron's big money poll of institutional investors, they found that 60% of institutional investors think that U.S. stocks will return between 5 and 10% over the next 10 years. So better than what is showing here, but still relatively low returns. Now, valuations are important, but you have to put them in context. And so what this is from a chart from macro research shop Strategas showing the earnings yield of the S&P 500. So what they've done is they've taken the PE multiple and taken the reciprocal to create an earnings yield, just like a bond yield. And then from that, subtracted off the 10-year yield. And the reason they're doing that is they're creating an excess yield curve. Now, if you look at a high yield, that's good. That's showing the market's actually cheap. A low yield, just like a low bond yield, is bad, showing the market's expensive. The average has been about 63 basis points. Right now, the market's at 180 basis points. So the market versus bonds, and considering bond yields, is actually not that expensive. It's actually quite cheap. The other thing we point out is, while it's true low or high valuations lead to lower returns, not necessarily in the short term. And this from BMO shows that if you look at the correlation between valuations and returns, it's a poor predictor in the short term. It's a better predictor in the long term. It just means that short term, expensive markets can get more expensive. It doesn't necessarily mean that they have to go down right away, if that is a comfort. Now, if we are basing valuations off of low bond yields, you better hope bond yields don't go up. And unfortunately, that's exactly what has been happening so far this year. You can see the white line, the 10-year Treasury. You can see how it's been moving up. So that is a concern for the market. Now, again, Strategas, they polled their clients, and we are one of their clients, so we had an input on this, asking at what level does the 10-year have to get before you become concerned, the so-called danger zone. And they said that was about 2.5% over the next year. You can see right now at about 1.6%, you're 90 basis points away. You still have room for that 10-year to move up. The other thing I would point out is that if we look at the pre-pandemic level, which was about 1.9%, we're well below that. The stock market has more than made up its gains. The bond market has not. So yes, yields have come up, but keep in mind, they're not even back to where they were before the pre-pandemic. One thing to look at this, though, if you look at that blue line, this is 10-year break-even rate. So it's the market's expectation of inflation. And that actually is what's driving the yields up. And that has gone above the pre-pandemic levels. So that is something you definitely want to keep your eye on. Is it a concern? Are bond yields a concern here? Not necessarily. Let's look at a couple charts. This is again from BMO, making the point that over a course of a year, if the bond market or 10-year yields go up 50 to 100 basis points, you traditionally have seen the highest returns. And that makes sense. If you think about it, that yields are going up because the economy is strengthening and earnings are going up, that's a good thing. So higher bond yields, not necessarily bad for the market. Same for inflation. Strategas points out that from 0 to 4%, you've tend to have the highest valuations. It's only when you get above, let's say, 4%, where you really run into problems. Now, I mean, I would say that it's the speed rates go up, it's the speed inflation increases that you also have to factor in. And we're a little bit more concerned with what inflation is doing, and we're going to talk about that a bit later. Before we do that, though, let's look at a real-world example of how this might play out. And one of the things we hear is people drawing a comparison to this market and high valuations to the tech bubble and making the point what burst the tech bubble was higher rates and whether now we're going to get that correction. In reality, that's not quite what happened during the tech bubble. If we take a closer look and you see that brown red line showing the 10-year, you can see that 10-year rates started to rise well back in 1998. They continued to go up for 15 months, adding 260 basis points, so a lot more than what we've seen lately, and then they start to fall. The white line is the S&P 500. It was still going up, and in fact, it didn't peak well into the year 2000. At the same time, you saw earnings peak. So it wasn't bond yields that was the trigger and the catalyst for that. It was earnings yields. Earnings yields went down the same time as bond yields. Now, fair point, it could be that higher yields caused the economy to slow and that caused earnings to eventually go down, but it happened with a lag. And we think that that's what's going to happen. You're going to see that progression and you're going to have a warning sign. So watch earnings, and on that note, earnings are more than fine. You can see from this chart, earnings growth in the first quarter are beating expectations, expected to come in at 6%. For 2022, which is probably a better comparison, earnings are estimated to be up 13 to 14%. Now, some concerns about tax increases that might take 5 to 8% off of that, but it still would be more of a one-time event. So earnings are in very good shape. Another reason why it's tough, even at these valuations, to sell the market at this point. Okay, so now let's move to the right tail. What are we watching that would be a signal that we've moved over to the right tail and you have to be a lot more cognizant of market returns? And of course, it's inflation. And this is again from the Wall Street Journal. You can see inflation has started to move up. Now, the Federal Reserve will tell you that it is transitory. It's short term. It's going to go back down. And they have a point, because the line is showing expected inflation that the market is showing. In other words, you can see this traded in the market. It's showing inflation trending back down to 2% over the next 10 years. So the market would tend to agree with the Fed. We would say that there's a risk that inflation rate goes higher than what's showing here and may not trend down as it's showing. Now, why are we so sure we're going to see higher inflation? If anything, just because of what we call the base effect. So you can see in this chart, you can see what inflation did during the pandemic. It went down quite a bit. If you annualize that, the year-over-year increase over those decreases, just based on that, you're going to see high inflation. But market's not going to be is not going to care about that, because everyone understands that base effect. But it's going to be a bit of a jolt, because you are going to see, if nothing else, you're going to see higher inflation because of that. We think also, though, on the supply side, you're seeing in the supply chain a lot of inflation. So this is from, again, the Financial Times. All the Federal Reserve districts are reporting higher raw material prices. And then from the Wall Street Journal, purchasing managers are saying it's taken a lot more time to get deliveries, and the input prices are going way up. The supply chain is stressed, and prices are going up. The question is, how much of that will be passed on to us, the consumer? Now, not only is the supply chain a source of inflation, so is the demand side. So we can see from this chart, it's showing personal income during the last number of years. You can see the blue line, how it dipped down during the pandemic as people were laid off. But the sort of the brown line was income replacement. The government came in and made everyone whole. Not only did they make them whole, they made them more than whole. We saw excess transfers to the point where Americans saved an extra $1.8 trillion. Part of that was the extra $900 billion in stimulus, but part of it also was because they didn't have the opportunity to spend. And so it's estimated households have saved almost a third of that. So there's a lot of pent-up demand in the market that, as the economies reopen, that's going to be released. Now, one of the things we hear, though, is people saying, look, you can't get inflation because the economy is operating below capacity. But according to Goldman Sachs, they would point out that the amount of stimulus you're going to have this year versus to what they estimate that output gap to be, it's 6 times. So quite a bit of stimulus for the amount of output gap. Again, the potential for inflation. Now, this is a quote from former Treasury Secretary Larry Summers. He thinks the American Rescue Plan, this last approved plan from Joe Biden, is the least responsible economic policy in the last 40 years. He says that there's a 1 in 3 chance of significant inflation over the next few years, and he thinks that inflationary expectations could be de-anchored. That Larry Summers is saying this is significant. Not only is he a Democrat, so you think he'd want to toe the party line, but he is also an advocate of using fiscal stimulus rather than monetary stimulus to fight what he calls secular stagnation. That Dr. Summers would find this to be a bad idea is something you need to take note of. Now, we actually think the Federal Reserve might be right. Transitory, a lot of what you're seeing when the fiscal side is short term, it's going to run off. And certainly it's the supply chain, it's going to work its way out. Why we worry, though, is we don't think what we're seeing on the fiscal side is going to be a short-term phenomenon. We think that on the Democratic side, that it's a chance to reshape government's role. And we also say if the Democrats were to lose power and you have a Republican administration, they're not going to be the ones coming in and cutting spending either. So we think that there's a lot of support from the American people for this belief. 70% of adults favored the American Rescue Plan, the $1.9 trillion, and this is a quote from George Bernard Shaw: "A government that robs Peter to pay Paul can always count on the support of Paul." I think you're starting now to use fiscal stimulus in a different way, and we think that's going to be continued in the future. The Federal Reserve is going to play a role in this. Their role is to keep rates relatively low. They're going to let them move up a little bit, have the yield curve steepen, sure, but they're going to keep rates relatively low, real rates really low, in order so Biden can continue to spend. But they're also going to run the economy hotter, and they're going to accept more inflation. They want to draw more minority participation into the economy, and they like to see higher wage growth. So all of those are positive for Main Street, not as good for Wall Street. Now, what does this mean for investment portfolios? Because in an environment of higher interest rates, higher inflation, not all sectors and stocks are going to be created equal. So you have to look beyond the major sort of headline indices. And this is a chart from Bernstein Research showing how companies are valued based on the present value of discounted free cash flows. And for a growth company where their earnings aren't that high, maybe they don't even have earnings, it's really the terminal value of the company that matters. So growth stocks are more interest rate sensitive because the value is more in that terminal value, which is further off into the future. So growth stocks do better as interest rates fall. They don't do as well when interest rates start going up. Value or cyclical companies are the opposite. It's more about the earnings, and that means they are less interest rate sensitive. They tend to benefit more or lose less as rates rise. Now, again, even within that cyclical value category, though, not all companies are created equal. When you look through the impact of inflation, some companies are better at passing through inflation than others. So you also have to think about the impact of inflation on profit margins of companies. So what does well in an inflationary environment? This is from Bank of America looking at during an inflationary time periods, what sectors have performed better. Energy and materials, it makes a lot of sense. I mean, you can easily pass through price increases if you are a materials or a energy company. We also think financials do very well. They're a cyclical type business. A steeper yield curve helps their net interest margins. Loan growth is better in a better economy. We also think industrials and real estate, again, do better in a better economy. Technology, I mean, they have pricing power. They do good with inflation, but we're worried about, again, that present value of cash flow in a higher interest rate environment. So we would leave that one to the side. So where do you find companies like that? Where do you find sectors like that? Well, if we map out and show by different countries their sector allocation, and we look just at those cyclical sort of sectors, you can see the US is a growth market. The major indices is more growth, about 29% exposure to these industries that you would want in that environment. But look at Canada, 73%. So Canada, in an inflationary environment, has more of what you're looking at for in the different sectors. Now, we are not saying you should sell your US stocks. The US market is incredibly deep and dynamic. What we are saying is, for your exposure to US stocks, you may want to rethink a passive index approach because you're not able to allocate to companies and sectors that you want that can give you exposure to the sectors you want in an inflationary environment. Now, also, higher inflation has implications for asset allocation. And this is a chart, again, from Bank Credit Analyst. You see the top line is the correlation between stocks and bond yields, whereas the bottom line is showing inflation. They break up the environments or the different time periods into three different buckets. And the bucket that we're in right now is a time period where the stock bond price, or yield, sorry, the stock bond yield correlation is positive. And this is a time period where inflation has been low and predictable. That's why that correlation is positive. What does that mean? What can you expect in this environment? Well, when bond yields go up, stock prices also go up. When stocks go down, bond yields go down or bond prices go up. This is an important point because in a 60-40 portfolio, you can hold bonds and they help deal with the volatility of your stocks. When stocks are going down, your bonds will protect you. But that's in a low inflationary environment. Look at what happens when inflation is above 2%. It's the opposite. So bonds are no longer protecting you in environments where stocks are down. They will be down as well. And so if you think stocks, or rather if you think inflation is going to go above 2%, the role stocks, or rather bonds, play in this diversified portfolio, in this 60-40 portfolio, needs to be rethought. Now, again, we're not saying sell all your bonds. You know, bonds have a role in the portfolio. We particularly think some good credit strategies make perfect sense going forward. But you don't want to hold just stocks and bonds, and you don't want to hold the bonds to protect you for your stock volatility, because it's not likely to act like it did in the past. So what does work well? What kind of bond replacement could we find? Well, again, gold and commodities, same as materials and energy. I mean, they are good in that kind of environment. Value versus growth, we sort of already have gone over that. The problem is in a 60-40 portfolio, you're looking for an alternative to your 40% bond weight, not your stocks. You have a lot of stocks. Your problem is to find something to take the place of those bonds. So a couple ideas in that: infrastructure, real estate, both hard assets, both are able to reprice their revenues with higher inflation. So in real estate, your lease payments, you're able to, as long as you have quality real estate, which is key, you're able to reprice that and get higher lease rates as inflation goes up. We think that's a good product to have as a bond replacement, and I think a lot of people are looking at that, and I know John's going to talk a bit about that. What do you don't want to have? Well, again, you know, think about that terminal value asset, the asset that's valued just on the terminal value, that if the discount rate goes up, it's going to go down in value. But you certainly don't want to own an asset where you're not sure what that terminal value actually is. And for that, I present to you Dogecoin. So Dogecoin, if you've never heard about it, ignore everything I'm going to say because you don't need to know anything about this product. It was created in 2013 as a parody against cryptocurrency. It was created as a joke. It's now worth, last week, it was worth $50 billion. So market cap of $50 billion, I think it's 35 now. It's very volatile. That's more than Ford Motor or Heinz Kraft. So I would say this is one you don't need to own, especially when you question that terminal value. Now, if you don't want to own an asset with a high terminal value, what you certainly don't want to do is you don't want to leverage to buy it, especially if interest rates start going up. So you have the volatility of the terminal asset with leverage, like this guy did. Bill Huang of Archegos, he bought a portfolio of heavily concentrated growth stocks, and he levered it 5-to-1. He lost $20 billion in 2 days. A strategy that perhaps needs to be rethought in a higher inflationary environment. So let's sum all of this up. Goldilocks is good for the markets, and that's where we think we are right now. We think the left tail has been eliminated, we hope, right? I think we all hope that hopefully the worst of COVID is going to be behind us. The market's expensive. There's no getting around that. But as long as rates stay manageable, the value, it's hard to sell given the amount of stimulus we see in the market. There will be a time when you will want to sell. We actually think there might be a correction coming, and the key to watch is going to be inflation. That's going to be your signal on when this regime is going to change. Now, what's interesting, this is from the Bank of England. This is their estimate of where they think inflation is going in the next 5 years, and full credit for being authentic, Bank of England, because they're saying it's anywhere from -1% to 5%, meaning they don't know, and no one really knows, right? Inflation is the big debate we're seeing right now. And again, we think you could get a correction when you start seeing those high inflation prints. We just think there's a chance that becomes transitory. Longer term, we really do think inflation is headed. We don't know where it's going. We just know we think it's going higher. And because of that, you need to rethink your portfolio construction. We're all going to have to learn how to fly in this new environment. And with that, I'm going to pass it over to John.
Thank you, Rob. Well, good day, everybody. For those of you who don't know Rob well or haven't had any experience with him, he does have an internal reputation of being a little doom and gloom. But with this Goldilocks message today, it was very clear to me that Rob took his happy pills this morning, and I'm really thankful for that. I appreciate Rob. That was really positive. It was great. And that does beg the question, are happy days here again? So we have to take a look at who prevails in the future. And my focus for the time that I have here is to really go over a couple of things. Number one, where might returns on asset classes go, and in particular, private assets? And should private assets become a higher allocation to your portfolio? Which segues us into two other areas that are important for clients. One is where taxes might be going, given all of this money that's been borrowed. And speaking of the money that's been borrowed, how is that going to get repaid? And maybe more importantly, who's going to repay it? And with that question, you might be a little surprised what our conclusions are. But let's go through this and see where we end up. So for the last year, markets have been on a tear, not just in the US. The TSX is up 50%, London 32%, European stocks 51%, the Hang Seng 29%, and the New York Stock Exchange overall 61%. But when we take a look at this historically, it's not quite the same picture. So what you're looking at here is a graph of the S&P 500 from 2000 to 2021. And the actual returns are very muted by a lot of crises. The dot-com bubble took the market down 48%, great financial crisis 54% in 2008 and 9, and COVID was actually so far relatively mild, assuming that we have seen the worst of what will happen to markets as a result of COVID. The net result is that the total return, the index return, the price return, has been 2.67%, relatively modest to say the least, and only 6% when we include dividends in Canadian dollars. And then when we take a look at the NASDAQ, because technology stocks have been on such a tear, especially over the last 2 or 3 years, the returns are actually worse. The NASDAQ peaked early in March of 2000, and it took 17 years for that market just to get back to where it was at the beginning of the dot-com bubble. And the returns for the last 21 years have been roughly 3.5% per year. So as we take a look at this, David alluded to the importance of a different asset allocation model, and this actually is a Talmudic asset allocation model that actually does exist. It's a biblical-ish model. It says it's advisable for one that he should divide his money into 3 parts, one of which he'll invest in real estate, one in business, private or public today, but private back then, of course, and a third part to remain always in his hands, which is really an alternative to fixed income. And this is the asset allocation mix that we use in our core portfolio today, which has a striking resemblance to that 2,000-year-old model. So the important part of any model is, of course, how it does in a crisis. And the last crisis was, in fact, obviously the year 2020. If we take a look at a 60-40 portfolio, which is in the line that's in red in front of you, the return bottomed at minus 10.8% in March of last year, and that compared to minus 5.7% for the core portfolio that you just looked at, which is what we use. The return for a balanced portfolio was about 5.8% because of the great recovery in equity markets for the rest of the year, but still below the 7.5% that the core generated for the 12-month period of time. And maybe most importantly is this what we call standard deviation. The lower this number is, the less risk that you're taking in the portfolio. The difference between the two portfolios is that core was 45% less volatile than a 60-40 portfolio. Now let's take a look at, since we've just looked at the past, at the future, where these things might be going. We just saw this, I don't know, I Googled this and I ran into, I just thought it was kind of cute. Dear past, thank you for all the lessons. Dear future, I am now ready. Well, that'll be an interesting question. Are we ready? We recently put out a newsletter called Born Under a Bad Sign, a great blues song that was recorded by Albert King in 1967, and a year later, The Cream. One of the lines in it is, if it wasn't for bad luck, I wouldn't have no luck at all. And it's an interesting way to frame how we might look at assets and returns in the future. So this is a list of companies. It was put together by Morningstar, major investors, BlackRock, JP Morgan, Morningstar Research Affiliates, and Vanguard. And it asked them for their expected returns on equities and bonds over the next decade. You can see on an average basis, while U.S. equities, they're only expecting a 3% return, and only just over 6 for emerging market and developed market equities, and bonds, only 1.3% return. Nominal, that's a nominal return. That's before fees and inflation. So when we take those out of the equation, the future size of a portfolio is incredibly modest. In fact, if you put it together in the area that's highlighted in yellow as a balanced portfolio, 60% stocks and 40% bonds, the actual net rate of return expected by this group of 5 organizations over 10 years net of fees is 1.3% per year. It's very disappointing. And they're not the only group that's come up to these conclusions. Credit Suisse just recently published their annual yearbook. It's very long, about 250 pages long, and their predictions are that for the next 20 years is for what they call Generation Z, is about 2% for a 70-30 balanced portfolio. Now that compares to the boomers having experienced more than a 6% real rate of return, and even the Gen X and the millennials well over 5% a year. So there's a very big shift that they're expecting on a go-forward basis. And as far as Canada's pension plans are concerned, and it's important to pay attention to them because their track record on a global basis has been truly outstanding. They're considered some of the best investment experts in the world. And we took a look at one in particular. This is the Alberta Investment Management Company, Corporation, I should say. And if you take a look at their predictions, this is again over a 10-year period of time. This is what they think they will earn. Their expectations for private assets is somewhere between 6% for real estate to 10% for private equity over the next decade. Their best hope for outcome on publicly traded equities is between 4 and 5.5% a year. And their total return that they expect to earn on a balanced basis is just under 5% a year. Their historical return for the last 20 years has been 8% net. So they definitely expect to take a haircut for the next 10 to 20 years. And they're going to make changes to their investment strategy by increasing their allocation to private assets. In fact, this was an article that came out not too long ago. As of November 2020, 96% of large plans, these are large pension plans with more than $5 billion of assets, and 73% of overall plans either held alternatives or intended to add to them in the next 12 months. So we would expect to see more money moving into private assets. So let's review where the private assets that we manage for our clients now stand. And real estate would be the place to start because it's the largest single private asset class that we have. Currently, it's about $5 billion of gross assets, about $2.6 billion of client equity. And we have 3 funds, the Canadian Real Estate Fund, the U.S. Real Estate Fund, and a Value Add Fund. Now, the Canadian Real Estate Fund was created more than 16 years ago, and it has earned a 9.1% rate of return since then. It is designed to be a conservative, income-generating real estate pool. The U.S. real estate pool is very much the same as a Canadian pool. The returns have been better there. The time frame is different. It's from 2010, and the returns have been 10.8% a year since then. And then a higher risk, but also a more promising kind in terms of return pool that was created in 2014, mainly by client demand, was the Value Add Fund, which does developments both in the U.S. and in Canada, and its return has been around 14% since 2014. Now, it begs the question because coronavirus is going to have some impact on real estate, and much of what's been published so far suggests that the impact is going to be quite negative. These are just some articles that came up during the last year, and a lot of concern, especially as it relates to commercial real estate, office real estate in particular, and of course retail. Is the glass half full or is it half empty? So let's take a look at this. This was a CBRE report. Now this came out roughly around August of 2020, and this was what they had to say. These were the 5 key takeaways. So remote work looks and feels productive to most, 90% plus. Remote work is here to stay, 85%. The office is also here to stay, so a little contradiction, 60%. Real estate portfolios might look different, 43%, and there's no one size fits all, 54%. So let's fast forward from August to a couple of weeks ago, and this was from Robert Half, a survey that they completed. And in terms of what are people saying about returning to the office? So the remote issues were essentially that there is a weaker coworker relationship at home, fewer career advancement opportunities working from home, and decreased productivity while at home. Those were the top 3 concerns. The return to office wish list, though, includes the ability to set up preferred working hours, the ability to deal with commuting expenses, having better personal office space, having a relaxed dress code. I was just thinking this may be the time when, if Harry Rosen can figure out a way to sell $1,000 tracksuits, it might be a time to consider buying that stock. And employer-provided childcare. These are all conditions that people are saying that they would like to see. But when you take a look at the total responses, what you see is 51% prefer to work either in a hybrid in and out of the office or fully in the office, for a total of 70% as opposed to 30% who want to work fully remote. And the question is, 70% is a pretty good number, and it may end up being a higher number than that. So will this actually reduce the long-term need for office space, especially if more space is required to provide the appropriate social distancing? It's hard to say. So what are the conditions, the future questions that we're looking at with respect to real estate? So first, will North American population increase faster than Europe and Asia? Because demographics and population make a huge difference. Will the overall economy be bigger in North America, which is where our real estate is focused? What role will technology play in terms of how we learn, work, and buy? Will certain regions in North America grow faster than overall growth? And what impact will demographics have? How long will financing rates remain low? What percentage of my portfolio should be investment-grade real estate? And what are the expectations of total returns in bonds, stocks, and real estate? So all of these are things that are considerations that we look at. But just one note here. As of roughly about a week or 2 ago, the request for subleases, that is companies saying we need to get rid of this excess space we have, has dropped dramatically. A lot of companies are withdrawing the subleases that they're offering, and appraisals in some markets and asset classes are recovering very significantly. So if we take a look at the returns for the pools that we have, I mentioned the long-term returns, but the intermediate returns. So for the Canadian Income Fund, last year was 2.2%, and we can compare that to how the REITs did last year, which was around -12. The 5-year return of 8% and the 10-year return of 8.9%. And thanks to a lot of changes in appraisals and very good rent collection this year, the first 3 months return for the Canadian Income Fund is 6.4%. In the US, it's 7.2, 10.9, and 11.2 over 10 years. The first quarter results are not yet in. And for the Value Add Fund, the results are 9.5 for last year and 14.5 over the last 5 years. It wasn't around 10 years ago. And as I mentioned, the rent collection for all of the real estate assets has been over 97% during 2020 and continues through 2021. In terms of comparing, many years ago, we made a decision to buy hard asset real estate, and that decision was driven because we thought it was would be a better way to get value add returns for clients, and also it would reduce volatility. We can go back and take a look at whether or not we were effective in getting that done. This is, the graph on the left is a graph of the U.S. real estate pool in comparison to U.S. REITs. And what you'll see is that there's a fairly significant difference in volatility. The blue line is the real estate pool, and the red line is a REIT index. The biggest difference we look at is that the actual return difference per year for the entire 11 years involved here is 17% each year, and the reduction in volatility is 80%. The numbers in Canada are actually a little bit better. The return difference is 27% a year for the last 16 years, and an 80% reduction in volatility. So these graphs basically explain why we choose to continue to want to invest and acquire hard asset real estate. There are other asset classes as well: private equity, infrastructure, private debt, and farmland, and they all have a role to play. This was a graph I noticed not too long ago, and I was very surprised by its conclusion, because I'll try to explain it, but if you look at the bottom, the further you go to the right, the greater the risk you're taking. And if you look at the left, if you go from bottom to top, you are getting a greater return. So what you want to do is get the highest return with the least amount of risk. That's the holy grail of investing. These two groups here are private equity categories. One is called buyout funds, which we would call traditional private equity, and venture capital is higher risk, growth-oriented or startup private equity. Buyout funds have a much better return than, let's say, small cap equities, but they have the same risk profile. And buyout funds have the same risk profile as investment grade bonds, but a significantly higher rate of return on a risk adjusted basis. BlackRock took a look at this as well, and the evolution of private equity. They took a look at returns in private equity versus public over the last 40 years and found that there was a significant gap, in this case, almost 5% a year, over a 40-year period of time. And in fact, when they look at it by decade, there was no decade from the 80s, 90s, the 2000 and 2010s where the returns for private equity did not outperform the returns for public equities. When we take a look at the U.S. endowments and state and local government pensions, the area in the blue at the bottom represents the change in alternative asset allocation for these organizations. And if you take a look at the endowments, for example, over the last 30 years, they've gone from 7% allocation to alternative assets, which basically means real estate and private equity and private debt, to about 55% currently. And in terms of our own private equity fund, we've had this fund in existence since 2012, but we've been doing private equity pools for clients since about 2008. Currently, the pool is about $460 million of assets. It has a 9-year history. It funds are almost fully invested. We don't really want to carry too large a cash flow because it reduces the returns. The last 5 years, the returns have been 10.5%. More importantly, they've been over 3% higher than the returns we've been able to earn on Canadian equities. And we've been significantly be able to increase our investments in direct assets as almost 50%, and that helps significantly to reduce fees. Major direct investments currently include McDonald Detweiler, which just recently went public, Vendasta, a software firm out of Saskatchewan, and Corfin. One other area that I think is important that we really wanted to focus on, which does involve investing primarily in public markets, is sustainable energy and innovation. And the big thing here that I'm looking at is the reduction in the cost of renewable energy, both solar and wind. And so whether you're looking at this as a requirement for climate change, and it almost inevitably will be, the point really is that the cost of the technology is dropping. So it's that one of the cheapest forms of new energy to actually create is in fact solar power. And once battery technology improves and transmission technology improves, this is going to get to be an ever larger percentage of the energy grid. Currently in the US, it's 11%. There's a really good paper. If you would like a copy, we'd be happy to forward it on to you, but put together by Rethink. Here are the conclusions they took. They believe that renewable energy is a disruptive technology. So it could be 100% of the US electrical grid by 2030. That seems like a big stretch, but nevertheless, that's the conclusion they've drawn. This possibility applies to most other developed countries. It's not just cleaner, it's cheaper, and it's massively disruptive. Sort of think of the way that Blockbuster and Netflix turned out. Growth rates in this area will be exponential, and the most important thing to realize is this, is that people say, well, we're going to need to depend on fossil fuels for maybe 30, 40, 50, 60 years. But more than 80% of the world is fossil fuel dependent. In other words, if they could come up with a method to deliver energy without using and paying billions and billions of dollars a year to import oil or coal or natural gas, they would. So you just have to assume that technology is going to drive this, I think, very rapidly. In terms of our Sustainable Innovation Fund, it focuses on both innovation, clean water, renewable energy, transportation as well. The results have been great since we started in September 2019. The fund is up 59%, but it's down 8% year to date. And it's going to end up being a volatile fund. And so for people that want to invest in it, this is a perfect pool to use dollar cost averaging to take away the impact of the ups and downs in the equity markets. Little sidebar thing that you might not know about. We have a donor advised fund, our own public foundation that we have been running for clients for actually almost 25 years now. And it's a little bit about it. So we created in 1997 for our clients. We manage about 150 different client donor advised pools or funds. It's currently holding about 120 million of assets under management. We pay 100% of all the operating and governance and administrative costs. So it's like our clients are able to get their own personal foundation without any overhead, essentially. And last year, it donated $10 million in gifts for various clients who wanted to give away. And with respect to some contributions, if you're donating public company shares as a gift to create a donor advised fund, your tax savings can be as high as 80%. And tax savings may become a critical issue for a lot of people going forward. So let's talk about tax time. This was a chart put out by the Fraser Institute about 3 years ago, and the most current one I could find. And what it basically showed is who pays what percentage of taxes. And right now, 54% of taxes are paid by the top 10% of income earners. This is in Canada. 21% of taxes are paid by the top 1%. So the question I would have for the government is this. If this is not an appropriate amount, in other words, 21% of the taxes being paid by the top 1%, then what is the right number? That is the dialogue that I think everybody should be having, is what is the appropriate number for people that have high incomes, the wealthiest people in Canada, what they should pay. I will tell you this, that Rob mentioned Joe Biden, his 100 days is coming up on Friday, and he is going to present, I've been told, a new tax bill to the Congress, and that tax bill is going to increase corporate taxes by 33%, and for going from 21 to 28. It's looking to increase the capital gains rate on people earning more than $1 million of income by 100%. In other words, it would go basically from 20% to 40%. So when we're talking about what might happen to capital gains taxes in Canada, you have to think that if our colleagues down in the US actually get these changes made, you have to wonder how long it will take for us to see these changes, especially as it relates to capital gains taxes in Canada. We did have a budget just recently. It was a non-event budget from a tax perspective, really. There were some minor tax changes. The real budget for that will come either next year at this time, or there may be a fall update. This is an election budget, so that's why so many giveaways were made. We're waiting for the other shoe to drop. And what might that look like? What's on the menu? Well, what's on the menu is marginal tax rates at the highest level going up, capital gains inclusion rate changing from 50% to some other number, 75. Could it be 100? It could be. And potentially a wealth tax. In terms of, this would be probably the hardest one to execute, and it is one that many other countries have tried and dropped as a result of it being relatively ineffective. So, what are the taxable strategies one can apply? And one of them is, of course, since you pay tax above $220,000 a year at 53.5% in Canada, you want to take a look at potentially income splitting. A family trust using prescribed loans right now is the simplest and easiest way to get income splitting to work effectively. The charitable giving I just mentioned, using a donor advised fund, looking carefully at tax-exempt life insurance with or without leverage can be incredibly effective. Capital gains tax strategies, including whether or not you can take a look at reorganizing shares in your company to maximize the current capital gains rate, which is still at 50%, and then non-traditional portfolio design. So one of the things we pride ourselves in is our portfolios are designed to have relatively low turnover. So even if you have the 6, 7, 8, 9, 10% rate of return, only a fraction of that is actually taxable in any given year. And for most of our clients, that amount is somewhere in the 20 to 25% range at most. So you need a customized approach based on your situation. It needs to be bespoke. So now let's talk about the debt. Love this cartoon. This is an American saying to his son, someday this will all be yours. And in the Post not too long ago, here you go, kids, it's all yours. Just pay me back when you can for the rest of your lives. And this is probably the biggest concern that people have with respect to the debt issues is we're burdening our children and our grandchildren. And I thought, well, okay, I should look into that and see if that's actually the way it works. Let's consider some other things. Will doubling the national debt in both Canada and the US create an insurmountable burden for future generations? So, this is gained from the Fraser Institute showing the growing debt burden in Canada. You can see here on the right-hand side at the top, our debt since 2008 has gone from essentially $1 trillion to $2 trillion in a period of 12 years, and most of that obviously in the last 18 months. Now, how does it look province by province? Interestingly, you see a much higher debt ratio when you add provincial debt in Eastern Canada than in Western Canada. Alberta, notwithstanding all of the challenges it's had, is the lowest in the country, and BC and Saskatchewan are actually very close as well. So in the grand scheme of things, these are not completely unreasonable levels of debt. If we take a look at countries around the world, Japan, with 237% government debt to GDP, is the highest in the world. And, you know, other countries like Sudan and Greece and Lebanon, these are not big countries, but Italy is in there, and Portugal. And where do we stand with respect to the US and Canada? Well, the US is actually in 13th place on debt burdens at 105%, and we're actually in 26. We're basically in the middle of the pack. One other thing we'll have to take a look at, though, and I wanted to take a look at the idea, what happens to, at some point in time, somebody has to pay off this debt. That is the logical conclusion. You have to get your debt paid off eventually. Except what if that's not actually true? So you're looking now at a chart of British debt to GDP for the last roughly 350 years and about 120 years worth of debt in the US below that. Now, the first question is this. You see the peak, the Napoleonic Wars? Well, it may surprise you to know that this money has never been repaid. It has been rolled over, but it's never been repaid. And as far as World War II debt, where the US debt spiked by a huge amount, that debt is still outstanding. That principal has never been paid off. So sometimes we forget someone's debt is also someone else's asset. You can't own a bond fund unless you've lent money to somebody else. So as far as you're concerned, if they repay that money, you can no longer buy bonds if all of these debts were paid off. So basically, essentially, they've never been paid off. Last year alone, Canada, for example, between households, non-financial corporations, and government, managed to get this great recognition. This is where we were the largest borrower in change of debt to GDP of any country in the world. So not exactly a thing to celebrate about, I wouldn't think. But when we take a look at really what Canada has done generally, and this graph is a little hard to read because it's in yellow. This was put together also by the Fraser Institute about 3 years ago. If that yellow line is below the black straight line at 0%, it means there's a deficit. You can see in Canada's history, we have rarely had our debt reduced. We have occasionally, but very rarely. And this is our debt to GDP. And this is where we are now in March 2021. We're about 60% federal debt to GDP, still well under where we were at the end of World War II. So if we run deficits 90% of the time, how can our debt ratio stay the same or drop? So just bear with me on this relatively simple math. Imagine you live in a new country called extravaganation, and the only motto of that country is only a borrower be. And we're going to take a look at how the economic growth of this country works. It's $1 trillion to start the year. It gets real growth of 2%, which is $20 billion. Inflation growth of 2%, which is $20 billion. So the nominal growth, excuse me, is $40 billion. And the GDP at the end of the year is $1,040 billion. That's how the math would work. Now let's imagine that same country owed $500 billion in debt. It borrows $30 billion, so it has a fairly sizable deficit that year, and it now owes $530 billion at the end of the year. Now this would seem to be a deteriorating situation, but let's just look at the math. Debt to GDP is 50% to start the year. We're going to borrow 3% of GDP, 6% of the actual debt in the year, but the ratio at the end of the year hasn't gone up. It's gone down to 49.5%, and that's because the growth in the economy is still higher than the actual change in the debt. And this is a fundamental reason why actually the principal of this debt typically doesn't get repaid. So this is not exactly quite the burden that everybody's talking about for our children and grandchildren. This is the proof here. That orange space that you're looking at up top are the public debt charges in Canada as a percentage of the federal budget. 40% in the war, 29% in the Second World War, 30% during the debt crisis of the early 90s in Canada, and only 7% in 2017. Maybe it might be 8 or 9% today. But in other words, we're not actually in a debt servicing crisis either. So in terms of conclusions, the first thing I would say is asset allocation is a critical issue in managing both volatility and getting positive returns. And private assets in particular are going to add value to portfolios going forward. Debt will be rising. I don't think there's any doubt about that. And so will taxes. So the overall approach is this. Do your planning now and stay truly balanced in your portfolio. So with that, I want to thank you for the time you've spent, and I think we're going to be moving to some Q&A in a minute or two. Thanks again.
Thank you, John and Rob, for your always insightful perspectives on the current investing environment and the considerations one needs to keep in mind when making strategic adjustments to their financial plan. We have allowed time for a moderated Q&A session at the end of today's program. And I'd like to remind our audience, you are welcome to submit your questions using the Q&A function at the bottom of your screen. But before we get started, and to allow our speakers a minute to transition for the Q&A, I'd like to take this opportunity to show you our infographic, which is being created live throughout the presentation, summarizing the key topics. Welcome back, everybody. We're now going to move on to the Q&A portion of our presentation. Unfortunately, we aren't able to take questions from the floor as we would normally do at our Strategic Outlook. So today, I will be moderating the Q&A from questions submitted by the audience. As I'm sure there are a lot of questions to get to, let's get started with our first question. I've got them here on this iPad. All right. This one could be either for either of you, Rob or John. How would you deploy new cash in this market environment? You want to take that one, John?
Yes. Generally speaking, our view is we're not going to look at market timing, but I don't think anybody would doubt that when it comes to the relative expensiveness of assets, you would look at public equities as being in more dangerous territory. If there's anything I would be reluctant to invest in, probably more than that, it would be long duration bonds. So I would probably want people to look at whatever they do in fixed income to be short to medium duration. Okay. I would like to think that if they're going to invest in equities, it would be a staggered approach. In other words, especially if they were allocating a significant amount of capital today, they might say, okay, let's deploy this capital in our public equity allocation over the next 24 months in some staged dollar cost averaging way. And then I wouldn't take that approach with things like income producing assets like real estate because the volatility of those type of assets has always historically been quite low. So dollar cost averaging doesn't really functionally work very well for that kind of asset investment.
Okay, thank you. Rob, I have a question for you. It comes from our friend Rob Lucy. Inflation. I'm a little confused. It probably wouldn't be Venezuela-like, but with government spending to beat COVID, how do we protect ourselves?
Yeah, and we've gone through that. I think in what we've said, a diversified portfolio is the best way to protect yourself for that. So there are assets that act better in an inflationary environment that you want to make sure you get exposure to. And I'd add on to the last question is that, what do you buy? If you have money today, it's look at your current portfolio. Are there any holes in your portfolio? If you are just 60-40 stocks and bonds, you may want to be adding asset classes that give you that diversification and that inflation protection. And I think real estate is one of them. I think commodities give you the best direct exposure. I think some global diversification also makes sense.
I'm going to get you to carry on, Rob, because it's very inflation. There's an inflation theme here. What is the likelihood that inflation does not occur in a meaningful way? For example, innovation reduces costs. And how is Nicola positioned for that event?
It's a great question because there is a tremendous debate going on right now. I accumulate articles on inflation. It's been one of the areas that my file folder is overflowing right now with inflation articles. And some of them, I would say most of them are telling you there's going to be inflation, but there are equally good arguments for it not to happen. And one of the things that we haven't talked about is the impact of debt on growth. And there is a school of thought, certainly Gary Schilling and I know Lacey Hunt at Hoisington, money manager in the US, make the point that more debt is counterproductive. The utility you get from more debt diminishes as you grow that debt, and it weighs on economic growth. And we have to realize, we have to ask the question, why was inflation so low before the pandemic? What was happening before, and what has changed? And there is an argument to be made. We can't predict what's going to happen with innovation. That's the number one thing I think that can lead to inflation being lower. That's a good news story. I think the other thing, though, globalization, we worry that may reverse. John and I have an ongoing debate on demographics. Because there's an argument that is inflationary or deflationary. It can work both ways if you think of it from the demand side or the supply side. And I think also alternative energy is another one. We see a very big deflationary, powerful force that's going to come with alternative energies. Getting there might be more inflationary. So a lot of different moving parts, and that's why when I showed the Bank of England, their forecasts, that's why you have the spread. It's the big debate, and it's not going to be answered, in the short term.
I think that there's something you can add to that, which is right now what we've seen is massive, incredible stimulus around the world really has turned into essentially surplus cash or savings for entire populations. So the savings rates in Canada and the US are like at extraordinarily high levels. So a lot of people talk about the fact that governments can basically force money out and provide money to the economy, but they can't make people spend it. And so part of the issue is that you've got two different kinds of inflation. Right now, what we're seeing is the inflation of asset prices, because money is available to buy those assets. We have yet to see, we're starting to slowly see some inflation in commodity prices, which is now showing itself up in terms of end user and consumer prices and stuff like that. And that's the inflation most people think about when they talk about inflation. They're talking about consumer prices. Consumer prices are going to require people to spend, let's say, the savings that they've got now on something besides investments. They've got to spend it on products or goods and services. And there's some sign that that's occurring, but it's not exactly been massive so far.
John, I've got a question for you. It's real estate related. What exposure to real estate did you have last year? And do you have exposure to high-rise office? Are these areas to remain cautious, or do you see that as a buying opportunity?
Okay, so the first question is the allocation we have to real estate. And generally speaking, we've kept that in a reasonably tight level. It's roughly, overall for all clients within the firm, around 30%. In some cases, some clients are as low as 20%. In some cases, some clients are only comfortable having real estate, and their numbers might be 80 or 90% in real estate. So it depends to some degree on the individual. But in terms of what we would recommend, we would be in the 30% range of a total balanced portfolio, roughly. in terms of high-rise commercial, that's not a space that we have been in. In terms of, is it an opportunity going forward? Everything is going to be situational. There are probably going to be some high-rise office locations that, depending on how inexpensive they would be today, might be a worthwhile risk to take, especially if they were in a location where they could be converted into something different or something other than what they are, if that was the alternative. So if they could be converted from some combination of office only to office residential, okay, that would make a difference in terms of the usability of that space. It can convert into something else. I think for most real estate going forward, if you want to get better returns, you have to look at something within the real estate where you can add value to it. In other words, you can't just take it the way it is, pluck it into a portfolio, and just hope that as long as you keep collecting rents, the prices are going to rise. I don't think that model by itself works anymore. Something positive has to occur in the management of that real estate.
Okay. Now, with our investment model that we run, it's very much the pension type approach, where we have more private assets within our asset allocation. So this attendee wrote this question, which is, if a higher allocation to private assets results in less liquidity, is this a concern for the average Nicola client?
So the, the short answer is no, almost in all cases. And for example, let's just take something simple, because most people have registered assets, whether it's pensions or whether it's RSPs. And the actual thing is that very, very few people ever get to a point where they need this ultimate liquidity event on those registered assets. So really all that's going on is they need no liquidity event as the accumulation is going on. And when they get to a point where they need to start drawing an income, they simply need an income stream. So if the private assets have at least reasonable cycles of liquidity, in our case they do, but it's actually 6 months, it's actually quite a short cycle. And if they're also distributing an income, they meet the criteria very comfortably, so they can fit in to almost any portfolio for those reasons. But also, if you're 50-50 between public and private assets, that means 50% of your entire portfolio is already liquid on a daily, weekly, or at worst monthly basis. So our private assets are liquid on a 6-month basis. Our public assets are liquid on a much more frequent basis. So liquidity has not been an issue for any of our clients, and I don't expect it to in the future.
Okay. John, I'm going to get you to keep going on one more question. Okay. Comes from our friend, Paul Geyer.
Oh, okay.
Paul asks, given the return profiles of buyout funds and venture capital, does Nicola Wealth offer access to these asset classes?
Well, yes to one and no to the other yet. So the buyout funds, yes, we have our private equity pool very much focuses on buyout funds and the assets that we get involved in. The two or three large investments we've made just most recently, a year and a half ago, McDonald Detweiler with a group from Toronto, Northern Private Capital, Bid Capital with a group from Vancouver, or Bid, I should say, with Highland Capital from Vancouver, and Vendasta, which is a software firm in Saskatchewan. They're all buyouts. They're all private equity investments, but these are existing businesses. They generate positive cash flow. You know, they have significant revenue. They have significant staffing. So these are what we will call real businesses. When we get into the venture capital space, where we're talking about concepts and startups, and you know, you're taking a significantly higher risk, a significantly higher failure rate, that doesn't have a place in our private equity fund. We don't look for those kind of investments. What we are looking at doing is establishing a venture capital fund for those clients who have the appetite and the interest to want to invest in that next generation of companies, the startups, and primarily in almost all cases driven by tech. So you've got energy technology, financial technology, biotechnology, and all of these kinds of opportunities. So we will create a separate fund because the risk is separate for that, and that fund will likely be available sometime before the end of the summer.
All right, thank you. So Rob, Tom Oliver has asked a question about the Canadian dollar, and I'm going to wrap his question in with a question from another attendee as well. Can you discuss your view on the currency outlook? US to CAD. Is there any fear that the US has gone has gone too far with stimulus and inflation and could impact their position as the world's reserve currency?
We don't think so on the reserve currency. I mean, there isn't really an alternative to the U.S. dollar right now, and so I think there's a lot of room, yet for that to happen. Given the lack of alternatives on the Canadian U.S. dollar. I mean, currencies are always really hard to value and to judge, and what the drivers are. I mean, I think that there's a playbook whereby Canada is viewed as a commodity-orientated currency, that in an environment where commodities are doing better, that capital would flow to Canada. And I think there's some validity to that. I think the other things that move and influence the exchange rate is interest rate differentials between Canada and the U.S. and unemployment rate differentials. And Canada has done well from an employment point of view, and you can see with interest rates again moving in Canada's favor. I worry about maybe in the medium to longer term with the Canadian economy and the need to diversify away from commodities and away from housing. And we need to develop and diversify our economy. A strong dollar is not going to help us do that. So I would worry if the dollar starts getting too strong. I think that becomes counterproductive to Canadian economic growth.
Thanks, Rob. It's interesting, just before we came out for the Q&A, there was only just 3 or 4 questions in the Q&A box that I'm reading here, and the list now I think is over 50 long. We have reached the end of our Q&A session, but I'd like to commit to everyone that has submitted a Q&A question that we will answer all of your questions. So let me begin by thanking you, John and Rob, for your presentations and for participating in the Q&A. Appreciate you sharing your expert perspectives. And on behalf of John and Rob, myself, and the entire Nicola Wealth team, we'd like to thank you for joining us for our presentation today and for being such great supporters of our firm. It's in moments like these that we really understand, value, and cherish the relationships we have with all of you. If you'd like to learn more about our views emerging from 2021, we'll be publishing regular updates on our website, nicolawealth.com, and we'll be describing future trends that are going to be taking place, and we'd be thrilled to have you subscribe to our material. And please feel free to contact our advisory team at any point, and they'd be more than happy to answer any questions you may have. We hope you found our strategic outlook in this virtual format valuable and insightful. I wish you all a safe and prosperous year ahead. Thank you.